Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about whether you should consider your house as an investment. This is a question that's come in a couple of different times over the last few months from listeners. It's something that comes up semi-frequently in our financial planning practice and is something that I wanted to cover on the podcast today. We go over the arguments for considering your house as an investment, against considering your house as an investment, my take on whether you should do it, and the circumstances where you should consider your house an investment versus the circumstances where you shouldn't. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. So today on the show, I'd like to talk about your house. And the reason I want to talk about your house is we've had a couple listener questions come in recently about whether they should view their house as an investment. And this is kind of an age-old argument. Is your house an investment, or should you exclude that from your investment portfolio because that's where you live, and we shouldn't conflate those two things, your investments and your other assets that you need to live off of. So today on the show, what I want to do is put this in perspective for everyone, go over the arguments of why it could be an investment or might not be an investment, and then bring it back to my take on it and why it may or may not make sense to view this as an investment for you and your family. So this is an argument that's been going on a long time. And oftentimes in a financial planning setting, when we're talking about this with clients, I have noticed that people will use the argument that their house is an investment to justify spending a lot of money on improvements that they think they want. Well, we really want this new kitchen. We really want to put in a pool. Is that a really good financial idea? Well, it'll raise the value. Really, this is an investment long-term because we're putting money into it now. We'll get that money back later. And for that reason, we're going to allow ourselves to go out and borrow a bunch of money to get this stuff done. And that's perfectly fine, by the way. If you want to improve your kitchen or you want to put in a pool, there's nothing wrong with that at all. We're thinking about putting in a pool at my house sometime soon, and it's expensive, and my wife is trying to use all the same arguments on me. So there you go. In general, the arguments for why this could be an investment are as follows. Number one, you have equity in it. You buy the house. Usually, you put some money down on the house for the purchase. You borrow the rest of it. If you buy a $500,000 house and you put down $50,000, well, now you have $450,000 that you're borrowing to finance the rest of the purchase, and $50,000 in equity. And what happens over time, as you know, is you pay down that mortgage. You make a payment every single month. We don't really have any negative amortization mortgages these days, meaning that every one of your payments consists of some principal and some interest. The principal balance on your mortgage goes down every single month that you make a payment. And therefore, even if the value of your house doesn't change at all, you're gaining equity because you're paying off the mortgage. You're paying off the balance of the mortgage. So you have equity in it, and that equity grows over the course of your mortgage. Now, obviously, there is a market for housing too that's based on supply and demand and affordability and a bunch of other factors. And in general, house prices increase over long periods of time. And so a lot of people will, again, try to justify the purchase of a big house by saying things like, well, this is in an up-and-coming area. They're putting in a new train station down the road. They're putting in a new school next door that's going to make this area a lot more attractive. And the demand for this house years down the road, when we might be thinking about selling it, is clearly going to be higher than it is today. And we'll certainly get our money back. Therefore, we can afford to stretch our budget a little bit now. And in general, house prices go up over time. It's a good kind of quote unquote hedge against inflation. I was looking up the numbers on this here yesterday, preparing for this episode. And if you look at like the last 75 years across the country, house prices have gone up on average about 3.5% a year, which is good, but it's not that much higher than the rate of inflation. So in submarkets, and I live in California, the housing market is still pretty crazy, especially over the last 10 years. House prices have gone up by a lot more than 3.5% per year. But that's not true everywhere. I mean, it's a big country with a lot of regional nuances. So those are a couple of reasons. You pay down the mortgage, you grow equity in the house over time. The market value of your house is probably going to go up over a long period of time, albeit by maybe less than we think. And that means that if you pony up a lot of cash to buy a house today, when you walk away from it down the road, hopefully you can sell it for more than you paid for it, and you'll have a smaller loan to pay off with the cash that comes in from the sale. So you walk away with a lot of cash. And on top of that, as we were talking about a minute ago, you can put money into it and boost the value of the house. An updated kitchen is going to increase the value. A new front door or a pool is going to increase the value. And I don't have any hard stats on this, but I was looking at something sent around by a realtor recently that tried to quantify how much value you get back through these additions. And yes, if you put in a new $75,000 kitchen, the value of your house will go up, but it's never by the full $75,000. If you put in a $100,000 pool, the value will go up, but not by $100,000. And if memory serves, I think the only dollar for dollar improvement that makes sense is actually a new front door. It costs far less than $75,000, but if you put a couple $100 into it, say $500, that tends to work out and increase the value by at least that much. So yes, you can put money into improvements on the house. It increases the value, but that in and of itself is not a terribly good investment because it's almost always a losing financial proposition. Now, again, that's not Grant saying that you shouldn't do it, because that might be the right thing for your family. You might have plenty of cash coming in and be plenty able to afford it. But that's the fact of the matter is if we look at the investment merits of putting in a new kitchen or a pool, it's not compelling in the least. So those are the arguments for it. You have equity in it, that equity grows, the value of your house tends to grow, and if we put money into an asset and the value of that asset goes up, it could be reasonable to view that asset as a long-term investment. There are more arguments, I think, for why it might not be an investment. And the arguments against your house being an investment start with, well, it's your house. You need to live somewhere. I guess you don't need to live anywhere. You could go without a house or a place to rent. You could be homeless theoretically, right? But most people don't want to go down that road, and you do need to live somewhere. So some of your budget needs to go toward housing, and we don't want to confuse money going toward housing as money going toward some kind of investment, right? Especially if you have other people depending on you, like kids or a spouse or other family. So we might not want to confuse housing budget with investment savings. You don't want to live without it. And on top of that, when we think of investments, usually I like to think of them as secure, as things that we have control over in terms of when we buy and sell them. An investment is something that we put money into with the expectation that the value is going to go up over time, that we have the discretion to buy and sell at the right time for us. And with your house, you don't always have that discretion, right? The fact of the matter is that if you have a 4-bedroom house and you have your mother-in-law living with you and 2 kids who share a room, and maybe a guest bedroom or something like that, plus the master, well, you might not be able to downsize until you have fewer people living in the house. The kids move out or some other situation, right? So you don't always have control over when you buy and sell these things, which really is an issue for us thinking about this, thinking about your house as an investment. And honestly, it's only an investment if you plan to sell it at some point anyway. You might be in your forever house. You might be very happy there, which is great. And you might have a nice asset with a lot of equity in the house on your personal balance sheet. But if you never plan to move and realize the value of that investment, it's pretty hard to think of it as an investment in the first place. Okay. Now, on top of that, you have high ongoing costs. That's not in and of itself a reason not to think of it as an investment. A lot of other investments do. A rental property certainly has high ongoing costs that you might think of as an investment. Other, private and alternative investments have capital calls and other ongoing costs. But your house has you have a more immediate need to fix stuff that breaks because that's where you're living. And on top of that, when we think of your house as an investment, that equity you have starts to look really, really attractive, right? There are so many people on social media these days talking about how you can put a few $1,000s down and buy a rental property, and then you grow the equity in that rental property and get it rented, take some equity out, and then go buy a second one, and then all of a sudden you have this huge real estate empire with a lot of value and not very much equity, coincidentally. And when you view your own house as an investment, it becomes really tempting to take out a home equity loan against that equity, take it and maybe go buy that rental property or go put it in other investments or go buy a car. That concept's called equity stripping. And I can't tell you how important it is to let the equity in your house grow and compound and just kind of forget about it. It is there for you. Yes, you can use it. You can take it out and go buy a boat if you want to. But hey, the value of your house probably is going to go up over time. And if you add to that the mortgage that you have against the house going down every payment that you make, that builds your equity in a big way. And it simply gives you more options down the road in your 50s, 60s, 70s if you do want to downsize once the kids are out of the house. So if you think of it as an investment, it does make that equity more and more attractive. There are a lot of ways to access the equity, and we don't necessarily want to do that. So all goes to say that we shouldn't really speculate with the house that we're living in if that's foundational to your family. If it's not foundational to your family, you're comfortable moving every couple of years, or you're single and you're comfortable identifying places to live that are going to go up in value and then selling them and moving somewhere else. If that's part of your plan, then it's totally reasonable to view this stuff as an investment. Focus on the equity, sell it and buy something else when the time is right. That makes a lot more sense. So all this to say that, yes, you can think of this as an investment, but it may not be the best for your financial plan. It's personal at the end of the day. And on top of that, there's tax consequences here too, right? And so if you're that single person in their 30s who's buying condos and high rises, and when the time is right, you're going to sell that and buy another one that you think is going to appreciate, you're going to take the equity and put it into the next property, and now all of a sudden your net worth is growing. There's a lot of people doing that. There's nothing wrong with that. But there are a lot of tax implications you should be aware of too. The first one is that if you buy a condo for $500,000 and then it goes up to, let's say, $700,000 in value and you sell it, you have a $200,000 capital gain on your hands. Now, there's this section in the tax code called the personal residence exemption. And what that means is that any place that you own that you live in for 2 out of any 5 years, if you sell, or excuse me, I should rephrase that. When you sell your primary residence that you've lived in for 2 out of any 5 years, you are awarded $250,000 of tax-free capital gains. So if you buy that $500,000 condo, the value goes up to $700,000 and you've been in it for, I don't know, a year and a half. as any tax advisor would probably tell you to think hard about sticking it out for another 6 months before you sell it, because that would give you up to $250,000 of tax-free capital gains. Now you have costs and realty costs and all that on top of it, but it's a really handy thing to pay attention to. Here's something else that works well for a lot of people I've heard about, is because it's 2 out of any 5 years. My wife has some people in her family who've done great with this. They purchase a new house, they live in it, and their kids are grown and out of the house at this point. They live in it for 2 years. Then they go purchase another house and go live in it and rent out the first house for 3 years. They renovate it. They try to build value in it. They try to cash flow it out, meaning that they collect enough in rental income to pay the mortgage. But then before that 5-year window is up, they sell house number 1, take the cash, and then purchase house number 3. Once the 2 years is up in house number 2, they move on to house number 3, rent out house number 2, and they keep doing that in order to take advantage of this personal residence exemption. It's $250,000 per spouse, and so if you're married, $500,000 of tax-free capital gains is really pretty convenient. Now, you have state and local tax on top of that. Some states will adhere to that personal residence exemption. Some states will not. California, I believe, does. And so if you're living in California, you're paying state taxes in California. If you meet that 2 out of any 5-year rule, you have $500,000 of exemption at the federal level and at the state level. Not all states are the same. So understand where you're buying and where you're living. But it's a very handy trick to be aware of. Now, back to whether it's an investment. It's really personal, and it depends on your own financial planning, I think. You can make an argument that it should or should not be an investment, but I think the whole point of this discussion that I wanted to cover today is that your decision of whether to consider it an investment should be congruent with your values and the rest of your financial planning. So if you're a 30-year-old dude buying a $500,000 condo, living by yourself and trying to grow your net worth, and you know that you're going to be moving around a lot and want to settle down at some point down the road, then it's absolutely an investment. You have no strings to that condo. You can pick up and move at any point. You could rent it out and rent someplace of yourself for yourself. You could sell it, buy something else. That's very reasonable to think of it as an investment. And because of that, if it's an investment, you care a lot about the neighborhood, the short-term real estate market. You care about the 2 out of 5 year rule that I just went over. You care about what rents are going for. You may even want to rent it out yourself at some point. You care about what the HOA, the maintenance costs are, and the whole purpose is to boost the value so that you can sell it, take the cash, and then do something else with it down the road. Maybe do that same thing again with another condo or a house or another piece of real estate. Now, if you're married and you have 3 kids like me, if you're in a place that's temporary, maybe your job is going to move you a couple years down the road, or you're making a big family transition, or maybe the house is too small for your needs. If your timeline is short and you're going to be selling the house sometime soon, it's reasonable to think about it as an investment then. The moment that you start putting roots down in that house, the moment that you get into the school district that you want to, the moment that you want some stability for your kids, if that's important to you. For my wife and me, we want to stay in the same house for a long time. We like the schools where our kids go. We like the neighborhood. We have a lot of friends there. And we plan on staying in this place for quite a while. And if that's you, it makes no sense to think of this as an investment, because the short-term real estate market doesn't matter a whole lot. Yeah, interest rates matter a little bit, because if you want to put in that pool, you might want to borrow some money at the prevailing interest rates, and that could impact things. But for my wife and me, we don't plan on selling the house anytime soon. Yes, it's an asset on our balance sheet. We have a mortgage against it that's a liability, but we should not think of it as an investment because that's simply not congruent with the rest of our financial planning and the rest of our long-term family planning. So at the end of the day, it's personal. There's arguments for, there's arguments against. I was a guest on an Advisor Friends podcast here recently, and we were talking about the housing market. It's kind of in an interesting place. There's also a Wall Street Journal article that came out today speculating that the drop in residential real estate prices might already be over. And for months and months and months, home prices have gone up steadily every single month. In July, they went down for the first time. And their speculation was that price decrease trend may already be behind us. And I don't quite know that that's the case, but we're kind of at an interesting point in terms of residential real estate because mostly interest rates are a lot higher. A couple of years ago, you could borrow money over 30 years to buy a house at 4%. Today, that same mortgage costs around 7% in interest every single year, which means that a $500,000 house becomes a lot less affordable just because interest rates have gone up. Now, you can stay in the house you're in temporarily, meaning that if you're in that position where you've got a couple kids, the house is a little bit too small, it's not perfect for your needs, but you're not quite ready to buy something else, you can remain there for a little while. But eventually, you might be forced to move. And we're really in the early stages of the game of interest rates being higher. Interest rates went up very quickly over the last 18 months. And we have, I think the real estate world and the real estate market hasn't acclimatized to those higher rates yet. There's a lot more settling out of this. So we have a shortage of housing. Developers are trying to build housing as quickly as possible because prices are very high. That impacts affordability of housing, and you have supply and demand issues on top of that. House prices are high, and people who want to move simply aren't able to because of the affordability issues. So personally, I don't know, like all markets, I have no idea what's going to happen over the next couple of years. But it seems to me that if you are thinking about your house as an investment and you have some flexibility to relocate and to move, higher interest rates haven't really set in yet. People have just stayed in place. They're moving a lot less frequently. House prices did go down a little bit in July, as I mentioned, but the volume of transactions is down very dramatically over the last couple of months. So that's not particularly good for realtors. And I think that's just a testament to the fact that people aren't moving because it costs a lot more. I mean, even if you have the $500,000 house and you want to downsize and sell, take your equity out and buy a $400,000 house. The $400,000 house could easily be more expensive on a monthly basis to you than the $500,000 house because now you're paying 7% on a new mortgage instead of 4%. So people simply aren't moving. Now, should the market climate for real estate impact whether you view your home as an investment? I don't really think so. I think it comes down to what makes the most sense for your financial and your life and your family planning. The current market conditions should impact how you handle it, but shouldn't impact whether you view your domicile as an investment or not. So I hope this was interesting. This is something that people ask from time to time. And again, arguments for, arguments against. For me personally, we tend not to think about our house as an investment, but there are a lot of circumstances where you might want to do that. So that's it for today. Thanks for checking in, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.